Hi, folks. Burke here. May 2025 closed as the strongest May for U.S. stocks in 35 years, and the headlines barely scratch the surface. If wealth is your goal, you need to see which businesses sprinted, which tripped, and why those moves matter for every dollar you invest. Quick favor before we dive in. Tap like, smash subscribe, and, importantly, hit the bell twice so YouTube tells you when the next video drops. That small click keeps this evidence-based content alive. The month kicked off with a tariff pause between Washington and Beijing. That single headline eased supply chain nerves and poured lighter fluid on tech shares. At the same time, the Fed's preferred inflation gauge ticked lower, giving the central bank an excuse to sit on its hands. Bonds told a different story. The 10-year Treasury yield jumped to 4.4%, nudging mortgage rates higher and throwing a wet blanket on housing stocks. Translation: the so-called safe corner of the market suddenly looks shaky while great businesses reclaim center stage. Let's start with the winners, the companies that did the heavy lifting for the indexes and for our own value-aligned partners' portfolios. AI was the rocket fuel. Broadcom surged more than 25% as custom accelerators flew off the shelves, and NVIDIA's 69% year-over-year sales explosion catapulted the stock another 24% higher. Microsoft, Taiwan Semiconductor, and AMD each logged double-digit gains, proving that the silicon backbone of artificial intelligence is still in short supply. But it wasn't just shiny tech. Chart Industries, an old economy enabler, rallied on a wave of new hydrogen and LNG orders. CDW rebounded alongside a long-overdue corporate IT refresh. Even on the consumer front, Tesla sprinted nearly 23% as Chinese regulators warmed to full self-driving. Ulta Beauty posted a lipstick-fueled rally, and Inter Parfums showed that affordable luxury perfume still beats inflation. These moves had one thing in common: real revenue acceleration and undeniable pricing power. When cash pours in, share prices usually follow. Of course, not everyone enjoyed the party. In healthcare, patent expiration worries clipped Merck, Bristol-Myers, and AbbVie. Biopharma vendors Thermo Fisher and Medpace felt the chill too. Housing-related names like installed building products and advanced drainage systems sagged under rising mortgage costs. Then we had the headline hits. Fiserv tumbled on insider sale chatter, Apple slipped on soft China iPhone demand whispers, and even luxury titan LVMH lost a step on Asia fatigue. Remember, a bruised share price often says more about fickle sentiment than it does about a business's long-term value. Short-term fear sets the table for long-term opportunity. Here are 3 truths Wall Street won't tell you. Number 1. Follow the cash, not the clickbait. Investors rewarded companies with real sales momentum and pricing muscle. Number 2. Volatility is tuition. On March 13th, we bought Tesla at $239, which closed May out up $107 from there at $346. And we bought NVIDIA at $116, which closed up $19 from there at $135. It might have felt crazy when we bought them. It feels brilliant now. Of course, it's neither. It's just good process. And number 3, diversification isn't about owning everything. It's about owning the right things. A handful of durable compounders beat a boatload of mediocre names almost every time. This isn't my opinion. It's math. Trim a little euphoria where price has outrun profits. Reload quality in the names punished by noise, not numbers. And keep dry powder ready, because the next scary headline will mark the next great entry point. If you want a roadmap that turns panic into opportunity, let's talk. Great businesses outlast news cycles. Stay the course, own great companies. Everything else is noise. And don't forget, tap like, hit subscribe, and ring that bell again. It really helps us reach more investors who need straight facts instead of Wall Street fluff. See you next week.